Good day, this is your European Open briefing for Wednesday, June 29th. My name is Michael Florentiades. I am the Chief Economist here at XM, and here are today's key points that you need to know. The post-Brexit rebound is continuing, so we have mainly stock markets and partly the price of oil rising. The pound is keeping a safe distance from its lows that it reached earlier in the week. The EU summit yesterday did not result in anything concrete. I think the main lesson is that tough negotiations are ahead. And in today's calendar, we have the Eurozone economic sentiment, German inflation, preliminary German inflation, and we also have personal income and spending out of the US, an important indicator, as well as pending home sales. So we start as usual with pound versus dollar cable. I think it's safe to say that so far it's in a range of 130, 118. This is the post-Brexit low. It hit on Monday. And 134.18, that's the high it reached yesterday on a rebound. So traders are recognizing that there is some stability, but also a lot of downside risks. I think also that the EU summit yesterday showed the enormous gap that separates the UK and the rest of the EU, mainly expressed through the UK Prime Minister David Cameron. The UK wants to put in place curbs to immigration, whereas France's President François Hollande said the freedom of movement of capital, labor, goods and services is an important principle for the EU, which is non-negotiable. So I don't know how there is going to be, if there's going to be a European fudge, an EU fudge, how to bridge those two gaps over the negotiations. We'll have to see. There were already some attempts to hurt the financial sector in the City of London by taking away the ability to clear euro trades in London, which was a contentious issue between the ECB and the UK. So we'll have to watch that. There is also some stability returning to euro pound. The focus is on the 83 pence level, as you can see from the chart. Not as much fluctuation there in the past couple of days, let's say. The debate is who is going to be hurt more by Brexit, and just so you know, there is an argument that some analysts are saying that the Eurozone's weak south has important vulnerabilities that will come to the surface under the Brexit stress. It's a very well-known story of weak competitiveness, together with financial sector problems like Italian bank, let's say. So this is pitted against who is going to get hurt more, the UK or the Eurozone. It doesn't mean that both cannot get hurt, by the way. I mean, this is an argument just to have in mind that maybe people will be selling the euro using this reason. Draghi yesterday said that the Eurozone will lose up to 0.5% of output in the next 3 years due to Brexit, from 0.3 to 0.5% of output in the next 3 years. So expect a slower growth rate in the Eurozone. Now, on to the S&P 500. It staged a strong rally yesterday. It closed 1.78% higher during Tuesday. We have bargain hunters stepping in. I would advise caution though, as many analysts have been fretting about Brexit for months. And now that it happened, is it really such a great opportunity to scoop up so-called cheap shares that are not even 5% off their highs? I have my doubts personally. Of course, the prospect of monetary policy stimulus and more monetary stimulus has often been trumping other concerns in the market, but I'm wondering whether it's the best reason or the best justification to be bullish right now. This is something to think about that we'll have to watch. Just to show you how the initial volatility has subsided, I can show you a graph of dollar yen. You can see the very big spikes right after the announcement of the referendum result, but dollar yen at least has been keeping a fairly close range since that, between 101.5 was around like this week's low, and 103 level capping any advances of dollar yen. Now, the Japanese authority have reiterated that they are watching the yen very closely. We are seeing meetings between the Prime Minister and the Bank of Japan and the Finance Ministry. Now, of course, maybe Japanese policymakers don't like the 102 handle on dollar yen, but it's certainly, they do take some comfort that is much better than, certainly better than having a sub 100 handle. I would also like to draw some attention to the fact that the Chinese yuan is at a 5.5-year low versus the US dollar. That would have been a story that might have moved markets in, let's say, 6 months ago. Now the markets do not seem as scared by the devaluation of the yuan, but it's definitely a story to watch. Onto the calendar. We had the Japanese retail sales earlier, which were worse than expected. We had also, they came in at minus 1.9% compared to minus 1.6%. That did not hurt the yen though. We had GfK consumer confidence sentiment coming out of Germany stronger than expected, and UK house prices a little also stronger than expected, nationwide house prices. Looking ahead, we have a series of statistics from Eurostat, such as economic sentiment, industrial sentiment, business climate, consumer confidence for the Eurozone. So that will be important. Moving on, we are going to get preliminary German inflation. This comes out ahead of Eurozone inflation, so that's going to be key to watch. Later during the US session, at the start of the US session, we're going to have US personal consumption during May to come in at a relatively strong 0.4%, and core personal consumption expenditure price index coming in at 0.2%. And the day rounds up with pending home sales and weekly crude inventories. Sometime between the German inflation numbers and weekly oil inventories, we could get Draghi speaking at the Sintra ECB conference in Portugal. So that will be something to watch. Maybe he will share some more insights about what is happening with respect to ECB policy after Brexit. That's all for today. Thank you very much for watching and have a great day.